our mission and our thesis really is very contrarian in our space, or at least it has been for the last 10 years, in that we strongly believe in the value of active management for a certain type of client versus traditional robo-advisors that are primarily pumping passive as the end-all be-all.
Welcome to the Tearsheet podcast. I'm Zack Miller. In the wake of investment firm Vanguard's success, robo-advisors continue to usher in the era of indexed passive investing. Titan is a contrarian investment platform, which offers investment strategies used by hedge funds for retail investors. Titan co-founder and co-CEO Clayton Gardner joins us to discuss why he built a financial technology firm centered around active investing and what type of investors and clients this approach appeals to. Titan has also grown using organic and referral customer acquisition strategies, which combine incentivizing users to share Titan with their friends by reducing the AUM fees clients pay Titan, sometimes even down to zero. Titan's users are unusually active and involved in their investing, even if they count on Titan to make their allocation and investment selection decisions. Clayton Gardner is my guest today on the Tearsheet podcast. Before we jump into the interview, I wanted to invite you to Tearsheet's latest event, the Embedded Conference. A big theme on this program and on our reporting in general has been about how financial services are showing up everywhere, in B2B software platforms, in retail, in transportation, and in travel. The Embedded Conference brings together financial services, fintech, and vertical industries looking to create new financial products. We've got a great speaker lineup. Register today at early bird prices by going to our website and clicking on the Embedded Conference button at the top right of your screen. Here's my conversation with Clay.
So my name is Clay Gardner. I'm the co-founder and co-CEO of Titan. Titan is an investment app built like a hedge fund. So our mission is to democratize hedge fund investing and other forms of sort of elite investment products that historically have not been available to the masses. They've been available to only the top 1% or so. And so we're a mobile app. We invest your money directly into portfolios, and we explain everything that's driving your money along the way. So the experience that a hedge fund investor would get having millions or tens of millions of dollars invested, we let retail investors invest in with much less and a much better experience.
So this is definitely a departure from like sort of the messaging behind some of the early robo-advisors, right? Like which was stay away from sort of active investing and just, index and like, can you talk about where the idea came from, I guess, to go in that direction, the active versus passive, at least approach?
Definitely. And you're spot on that our mission and our thesis really is very contrarian in our space, or at least it has been for the last 10 years, in that we strongly believe in the value of active management for a certain type of client versus traditional robo-advisors that are primarily pumping passive as the end-all be-all. In terms of our story, I started investing when I was 12 years old, actually. My parents let me invest some of my chore money, the little that I had in some stocks.
What'd you buy when you were 12?
I think Google had just recently IPO'd. I knew absolutely nothing about it. And that, and plus probably 10 or 20 other stocks that I sort of heard about on Jim Cramer's Mad Money and these other kind of like financial blogs. Had no idea what I was doing. And like many folks know, from the early kind of post.com bust part of the 2000s through the 2008, 2009, beginning of the financial crisis, pretty much every stock in the US went up. And so, I felt like a genius the first 5 years of investing, as like a kid in high school. I went to college, went to business school at Penn, and the world kind of blew up my first semester. This was fall 2008. And virtually every stock fell. I lost a ton of money, and it really hurt. And I promised myself I would make sure I understood how to actually invest properly. I would not take stock tips, things I heard from others for granted. I would do my own research, come to my own convictions, and then decide. And so it ended up being the start of a very long and winding path in professional investing after I graduated, working in hedge funds, working in private equity to understand how some of the best money managers actually allocate capital. Funny story is my first day of school in college, I met my co-founder, Joe. And Joe and I had very similar passions, similar interests in investing, but we ended up taking very different paths over the next call it 5 to 10 years. So Joe actually went into consulting. He was top of his class in investment banking, and I went more direct investing route. But we stayed in close touch. And over the years, our path, we stayed very close personally, but our investing paths started to diverge a bit in the sense that I abided by what I told myself I would do. I learned professional investing at private equity firms, at hedge funds. But Joe, top of his class, Goldman Sachs banking, actually had very little money invested. He despite having gone to business school, having worked in some of the top consulting firms, had no idea how to invest his own money. And so this seems like there's this massive divide between folks that are in the industry and have the money, have the status to access these managers, versus folks that are still very smart, very educated, but maybe just don't work in investing full time. And so that idea had been brewing for years. And a few years ago, we ultimately decided to leave our jobs and pursue a solution to that. And so the solution today with Titan is, taking the investment experiences and products that are available to the top 1%, in terms of you have to have a certain amount of money, you have to have a certain amount of access and relationships, and we're democratizing those. We're making those accessible to the masses. And I can talk a little bit about how we're doing that.
Yeah, so let's talk a little bit about that. And then I'd like to segue into talking about who that target user is, because you sort of just hit upon that now. But let's talk about the first part.
Yeah, so the course, so we're an investment app, we're an SEC registered investment advisor. And so folks have likely heard of companies like Wealthfront and Betterment and some of the original robo-advisors.
Yeah, they've all been on this program back in the early days. Yeah.
And so the idea is that, using software, you can take a lot of what historically, human financial planners would do for you, which is, come up with an investment strategy, a combination of stocks, bonds, all the asset classes, ETFs, and invest your money across these, and occasionally rebalance and maybe get on the phone with you a few times a year. But that was a very archaic manual process 20 years ago. About 10 years ago, the advent of robo-advisors made that much more automated, much more tech-enabled. So software now does a lot of that automated financial planning, a lot of that passive investment strategy. We came at it, I studied computer science in college, and I've always been fascinated with technology. Came at it from the lens of, well, why hasn't software been used in the active management space, right? So hedge funds and private equity firms and all of these professional investors that try to, essentially outperform, the market averages. Why aren't they using software better? And if they did use software, could we make their strategies accessible to the masses? And so that's what we've done today. So we have one financial product, and we have over $35 million of retail investor money. So this is not the top 1% folks. These are folks from all walks of life. I can talk a little bit about that demographic, but we're a classic case of wanting to use software to retrofit an industry that's been around for a while, but for some reason just hasn't caught up.
Interesting. So let's talk about the target user. You said they're not the top 1%, but obviously they appreciate, I guess, an active approach and the hedge fund approach.
Definitely. I would characterize our core customer as a young professional. And young is a broad range. So folks, in their
depends how old you are when you say young. Yeah, exactly.
Yeah, I mean, folks in their early 20s when they graduate, when they're either in college or recent graduates into the workforce, all the way up until the millennial generation. I think is technically into their 40s at this point. And so, our core customers is someone who is a young professional. A lot of them tend to be specialists. So probably many of the listeners on this program, either specializing in, whether it's product development or engineering, consulting. We have a lot of doctors, dentists, lawyers. And so the one common thread about them is not necessarily how much income they're making or their investment experience. It's that, number one, they're specialists in their domain. So they value specializing and being the absolute best at their craft, but they don't have the time and resources to apply that same specialist approach to investing, right? And so they don't want to forfeit, to average returns. They don't want to be invested in a black box strategy. They want something a little more active, but they certainly don't have the time, resources, or experience to do it themselves. And so we kind of fill that gap where maybe a traditional passive robo-advisor is a little too hands-off, a little too average, quote unquote. Whereas do-it-yourself, brokerage like maybe an E-Trade or Robinhood or something like that is a little bit too active. It's a little bit too hands-on, and so we fill that void for those folks.
And so how are you reaching those to acquire them as new users?
So there's a lot of, so primarily our growth has been organic. And so word of mouth and referral strategy. I could talk about our referral program and some of the changes we made to that and how that's worked out. But, in terms of paid acquisition, we really think backwards from, where is that core client engaging, where are they spending time today? So it tends to be, there's a lot of like trade publications, right? So there's specific industry newsletters. You can sign up for different email newsletters, blogs, and then there's obviously the traditional paid social. But that in our view is a pretty saturated channel, like the Facebooks and Instagrams of the world.
So noisy, yeah.
Yeah, for a certain type of consumer, a certain type of investment profile, that can actually be still a very attractive part of the market. But for us, I would characterize it as definitely a primarily organic strategy. And so I can talk about how are we generating that word of mouth, how we're generating that referral, that referral rate.
Yeah, let's hear. We definitely, so we'd like to talk about marketing strategies and learn from one another on the show. So anything you're willing to share, we'd love to hear.
Yeah. So when we started Titan, I mentioned the investment strategy that we're democratizing. The second objective of ours is to help people actually understand what they're investing in. So this concept of content and media, we personally find fascinating, and we find that it's been super underutilized in active investing. And so when I say content, I mean, think about all the news outlets, the financial media, the CNBCs and Bloombergs of the world, that people are tapping into to figure out what the heck they own. If a stock's up 20%, down 20%, what should they be doing? Should they be buying, selling? That content is mission critical to people making good investment decisions, but it's super fragmented, and there's no quote unquote source of truth, right, for someone's money. And so the second objective of ours is not just to democratize investment strategies, but to help people understand how those strategies are performing and why. A natural byproduct of that is that the content that we create in-house gets shared amongst our client base, and it gets forwarded to other prospective clients, so that, folks, families and friends, et cetera. And so that was a big driver of word of mouth for us, right? It's like the companies that our clients own at Titan, every single day, the market opens, there's activity, right? There's events. A lot of it is noise. A lot of it's fundamental news that we have a say, that we have a voice on. We have a view on. And so we closely engage with our clients on that, and that content gets forwarded. And so it can be videos, short bite-sized videos, kind of carousel images that explain what's driving their money, short articles, and we have an email newsletter, et cetera. So in a nutshell, a lot of the traditional media strategies, that kind of, the Barstool Sports of the world, for example, I think that media strategy has been very underutilized for our core customer base in investing. And I think you have to be an active investing platform to be able to use that. It's kind of hard to, if you're a passive robo-advisor, I don't know if I personally would be interested in knowing the broad strokes macro perspective every morning. I feel like it would not change much. But when it comes down to owning specific companies, we found that our clients are super interested in the goings on in those companies. And the more we can engage with them on that, the natural benefit is that content gets shared, and that drives new client acquisition for us.
So that's actually something I really wanted to talk about, because we tend to think of investors in robo-advisors, at least, as being more passive and hands-off. They're letting the platform do the investing for them. But you have a different type of user at the end of the day. It sounds like even though they're not necessarily making a buy-sell decision, they want to be on top of everything. Can you talk a little bit about, I guess, their psychological makeup, I guess?
Yeah, I think it's a very aspirational kind of psychological view that our clients have. I would characterize it as wanting to be the smartest person in the room.
Mm-hmm.
Right? And so it's what would it take to be the smartest person in the room? It doesn't mean IQ. It doesn't mean where you went to school. It means when it comes to investing, it means how well do you understand the companies you own? Do you understand them well enough to be able to argue the bull case, why this company may be a great, long-term investment, or as well as you can articulate the bear case, why this company could potentially, face tons of competition and the stock could be overvalued. And so because, again, we're targeting a specialist young professional, that specialist tends to have that kind of similar aspirational aspect to their investing strategy. So they want to be the smartest person in the room. And I think with passive investing, that's just a totally different type of consumer. It's pretty rare that you find someone who's super interested in actively engaging with their money, but is also okay parking it in a portfolio of 10 to 20 ETFs that are, in each of those ETFs are invested in probably hundreds of securities. And even if that advisor wanted to run a strategy like Titan is running, there's only so much you can talk about with the 100 stock emerging market ETF, right? And so the more spread out your money is, the more diversified you are in fintech, we found that you kind of spread yourself thin as a content creator. And so our mission is to democratize investment products. And we can talk about other ones that we may be adding down the road, but we want to make sure that we stay concentrated enough so that we're not creating too much noise for our clients. We want to make sure there's a very high signal to noise ratio.
So I do want to hear about kind of what's in the product pipeline in a bit, but can we go back to, I know we're skipping around, but can we go back to your referral strategy? You said you made some changes there and kind of tweaking that. Can you talk about how that's set up?
Absolutely. So we kind of worked backwards. We said, what do customers despise about the investing industry, specifically asset management? The elephant in the room has always been fees, right? It's traditional financial planners often charge upwards of 1.5 to sometimes 3+%. Now, it's not totally clear that they're charging that because it shakes out in terms of expense ratios of the high fee funds that they're investing your money in. There's all sorts of annual administrative and custodial fees. And so most folks don't know that they're actually paying such high fees. And that is
right. No one ever cuts a check for their commission fees. Or
exactly.
Yeah,
and that's come under the limelight in particular over the last 5 to 10 years as passive investing has, we've been in a 10-year market, and a lot of active managers have not earned their keep. And so rightfully, there's been this conversation around, fees are so high. How many, what am I paying in fees? Should I be moving to a lower cost provider? And so we wanted to make sure that our referral program rewarded people and also solved, scratch that itch for the folks that came to us that are still maybe a little bit skeptical about asset management. So our clients today, we charge 1% of assets per year. And that's right around the active industry average. But we wanted to make sure that our clients can reduce their fees to zero by spreading the word, helping us grow the community. And so our referral program is unlike any other in asset management in that we're literally willing to give our product away for free for life on this current investment product if you refer 4 friends. So for each friend you invite, we reduce your fee by 25%, right? So if 1% fee per year, you share with 4 friends. For each friend you share with, you each get 25% off your fees. And so you can, we have many folks that are getting free asset management. Some have made 5, 10+ referrals. And the great part about that is that one, the economics make a ton of sense for us. So we've run the math, and this is a sustainable strategy. This is not like a typical kind of VC subsidized growth strategy that I know a lot of startups are willing to endure. It's one that's sustainable. And the best part about it is that it solves that issue I talked about, where folks that were previously skeptical about asset management or active management are now leaving their passive robo-advisors, coming to Titan, spreading the word, getting free active asset management, which is, I think, unparalleled in terms of other peers willing to do that. And we plan to keep that going.
It's a very generous program. So let's go back to, you talked about being a one product company right now, and it sounds like you have some ideas in the pipeline that you guys are working on. Can you share a little bit, I guess, aspirationally, like where you're trying to go with the platform and the products on it?
Yeah, it's always a balance. We found that it's a balance between, when you're an early stage startup, it's a balance between doing things that are innovative that your clients aren't necessarily asking for, but you think can be game changing in terms of the value proposition. And then also just keeping up with competitive parity, right? So like looking around, like what do your peers have that you don't have? And is that table stakes? And if it's table stakes, it can actually be sort of a Me Too product. It doesn't have to be number one in its industry. If the goal for your customer is just to get to competitive parity, right? It's that you don't want to lose clients because you don't have this thing that's table stakes. And so there's a number of features and products that we're thinking about along those lines. Like for example, a lot of folks in our industry right now, everyone's been coming out with a debit and credit card. I feel like everyone, there's this running joke on social media about, in the long term, every company is a fintech company and every fintech company is a bank. Because it's traditionally, it's just a very good business model, right? It's every time you swipe, your customers swipe, you earn a transaction fee, whether it's debit or credit. And, and everyone has one of these cards in their pockets. We're definitely thinking about things like that, but the more interesting and more innovative approach is obviously, the old Henry Ford quote, if people asked, if I asked what they wanted, they wouldn't have said a car, they would have said a faster horse. We want to make sure we're building cars, not just faster horses. And so as we think, our guiding light is, what do the top 1% of investors have in terms of investment strategies at their disposal, right? So we're democratizing hedge funds right now. What about ideas like private equity? What about private markets broadly? So think about like the startup space, think about even investing in like local businesses. Obviously much more liquid, much more fragmented, but an interesting idea. We can think about international equities, right? So we're just US focused currently. And then there's obviously much more alternative asset classes like crypto. So in a nutshell, we like to work backwards. Again, we start with, what our mission is to close this gap. So what do the folks that are on the other side of the gap have access to today? And then, how can we work backwards and bring those to our clients? And so I think in 5 to 10 years, our mission is, you come to Titan, you sign up in just a few minutes as a client with a very, very low amount of money to start, a very low bar. And you'll be able to get invested like some of the top endowments, some of the top, money managers on the planet. And that'll be across asset classes, probably have a different money manager running each kind of slice of your overall pie. And we're excited to build out that roadmap.
It sounds almost kind of like the Vanguard of active investing in a way.
If we get to be even a tiny fraction of what Vanguard has been, I think our clients, investors, and employees will be extremely happy. But yeah, that would be an awesome outcome.
So Clayton, I think we have time for one last question. You mentioned in your intro that you're a co-CEO along with a co-founder. I think we've done over 300 of these episodes. I think you're the first co-CEO that we've had on the show. Can you talk a little bit about how that works, and I guess how why you came up with that structure and how it manifests itself?
Definitely. So it's super uncommon for a structure like this to work. For Joe and I, Joe's my co-CEO. We found that we honestly can't even perceive it not working for us. We couldn't see it any other way. So Joe and I quickly became best friends. We met, like I said, on the first day of school, in undergrad at Penn. Joe and I are perfect complements when it comes to managing a company, when it comes to ideating and thinking about product development, when it comes to raising money, hiring, et cetera. I would characterize myself, and I think Joe would agree with me, that I tend to be more left-brained. So taking a very analytical, data-driven approach. My background is finance and computer science, and so everything I'm putting through a very analytical framework. Sometimes almost too much. So Joe comes at it from a very different angle. Joe spent time in consulting, but he's much more creative than I think he lets on. And so in terms of day-to-day responsibilities, Joe runs the creative side of Titan. So all the product development from a UI, UX perspective. Joe actually taught himself design. So everything that you see essentially in the Titan app on the website, Joe actually designed himself. And so Joe was thinking about product, UI, UX development. I tend to focus more working with our CTO, Max, who's also a co-founder, on kind of the engineering and product development, asset management side of the house. And so there's so many user problems to solve in this space. And we're a very lean team. We're only 7 right now. And we scaled to over 35 million of assets. And so I think there's just so much work to be done, but I think Joe and I complement each other in a way that, I think for a lot of folks, the co-CEO structure doesn't work, but for us, it's a pretty great hybrid.
No, I find it very interesting. I guess the corollary question is that you describe sort of how the work is split. At what point do you guys have to make decisions together? Like what type of decisions, I guess, require sort of 2 checkoffs?
Yeah, so there's definitely areas of kind of core functional ownership where I will let go, Joe will let go to the other because there's that general trust. And there's certain decisions where we will not. One of us, we will not waver if the other is strongly against. So hiring is probably the number one. If it's, we kind of like to abide by, what Brian Chesky or Airbnb, I think, their original motto was, which is, if it's not a hell yes, it's a hell no when it comes to a prospective employee, prospective candidate. We definitely take that approach with hiring. There's also things on the product roadmap front when we're talking about raising money from investors as well. If there's kind of, any sense of a yellow light, we consider that an automatic red light. And the reason is because these are decisions that are going to affect the company much longer than, one of us may be, a little bit disappointed that we lost, in a disagreement or an argument. These are things that will permanently affect the value of Titan. And so we're willing to sacrifice, okay, maybe I didn't, I really like this candidate, but, Joe, maybe saw something that seemed a little bit off. We just trust each other to make those decisions. So it's definitely not a consensus-driven framework, but there are certain large, meaningful company decisions that we definitely require, founder-wide buy-in on.
Thanks for sharing that with us. Clay, thanks for joining us on the Tearsheet podcast today.
You got it. Thanks for having me.